Good afternoon, everyone. I'm Tim Richards, Technical Services Manager of the Managing General Agents Association, and on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon. This is being delivered by Diest on the unique challenges and opportunities of premium payments. Before I introduce our presenters, I'd just like to run through the microphone and camera are turned off. If you'd like to ask a question, feel free to use the chats button answered at the end of the session. If we run out of time, questions will be answered after the event. There are some poll questions within the session, just to confirm that your answers will be anonymous. This presentation is accredited for CII CPD accreditation quality if relevant to your ongoing professional development programme. The briefing is being recorded, and a link to the recording will be issued after the event, together with the slides and our feedback survey. If you would take the time to complete our survey, I'd be grateful. That takes no longer than 2 minutes and allows us to continue to deliver the best possible future events to our membership. So to recap, today's briefing is the unique challenges and opportunities of premium payments from Diest. So let me introduce you to our presenters, Julian Shomig and Carissa Davis. Julian is co-founder and CEO of Diest. He is an ex-aviation underwriter with a finance master. On a fast-track career with Munich Re, he has been involved with aviation reinsurance in Munich, finance processes in New York, and innovation underwriting in London. He holds an MSc in engineering and finance and is ACII qualified. Carissa is compliance lead at Diest, a strategic business facilitator. She has had 2 decades experience running her own consultancy. Highlights include guidance in complex processes, as well as consulting in finance and tech with a meticulous approach. Carissa holds a BCom in Business Information Systems. So without further ado, do enjoy the briefing, everyone. And Carissa, over to you.
Well, hello, everyone, and thank you for joining us at today's market briefing. As has already been alluded to, we're going to be chatting about the unique challenges, but at the same time, the exciting opportunities that premium payments present. And it's a great honor to be presenting on this topic. As an active member of the MGAA, we've greatly benefited from the shared insights and collaborations within this community. And today, we're eager to contribute by sharing our experiences and lessons learned. We believe these insights could provide valuable perspectives to the community as we navigate ever-evolving industry dynamics. Thank you, Julian. Over to you.
Brilliant. Thank you very much, Carissa. And thank you, Tim, as well, for the fantastic introduction. I think you said it all. We are very, very excited to speaking with all of you, and thank you for dialing in your lunch hour to hear us speak about the premium payments topic. Particularly what we want to address today is 3 key learning objectives. So at the end of these sessions, all of you should be able to explain the unique challenges of premium payments, outline the key opportunities premium payments offer, and summarize the solutions for innovating premium payments. Now, that 3-tiered structure is as well the agenda, which you'll see for the next 45 to 50 minutes, where we'll guide you through a story of premium payments. Okay, let's jump right in. Chapter 0, what's the background? What are premium payments and what makes them unique? We have prepared 3 different sections to this aspect, and want to start with the first. Now, the word premium payments to all of us is something which comes which is very familiar, comes natural, which we're like brought up with in the industry. But the word itself has actually quite an interesting history. It comes from 2 Latin words, which mean pre and emere. Pre on the one hand means before, and emere means to buy or to take. So if you put those 2 together into the word premium as we use it today, it in essence means you buy something before you take the value out of it. So very much describing the risk transfer, how people perceive insurance policies, that you purchase something before you get the actual good, the claims payment, which hopefully never arrives, or if it arrives, then most likely significantly after the premium, the payment for the insurance risk transfer has occurred. Now, that origin of the word actually transcends very much into how we're understanding premium payments today. Premium payments, more generally today, are the cost for insurance cover. So that includes everything from your policy payments, any amendments, any cancellations you make, which means that premium payments can be both positive as well as negative in nature, and with the various different underlying payment flows can be coming from the original insureds, from business distribution partners, insurance partners, or any possible way. Now, in a comparison to finance, premium means actually something quite different. Premium in finance is an added cost on top of a financial derivative. Now, that is something which is quite distinct to the insurance industry, where the premium, as we understand it, is not the added cost on top of the risk transfer, which is delivered to the insurance company. The premium itself is the entirety of the payment which the original insured has to make, which includes the risk transfer, includes profit margins, includes commissions, fees, excludes the tax. But here again, the key distinction between finance and insurance, premiums have two different meanings. And the way the insurance industry understands premium is very much borrowed from the historic meaning of the Latin origin prae imere, which is very much in line with the nature of our business, taking on or paying for something before a service, i.e. a claims payment, occurs. Now, in line with that unique word, premium, follows as well a very unique payment flow in the insurance industry. What we've drawn out here is a box standard distribution chain and the respective payment flow. So on the right-hand side, an insured might purchase a policy via a broker who places that policy underwritten by an MGA, who gets the capacity from an insurer. Now, that's a payment flow all of us are very familiar with. That payment flow has two key characteristics, which makes it unique. The first characteristic is that one payment from the insured is split between multiple different entities. As we know, broker receives the cash first and passes it on to the MGA while clearing their commission. And likewise, the MGA then passes the money on to the insurer while clearing their commission. So a very unique situation where one payment triggers the payouts to, in that case, three different entities. Now, at the same time, the supply chain payment is only made for the first time when the good is sold by the original beneficiary, i.e. the insured in our case. Now, if we would apply that payment flow to any other distribution chain in the world, we might wonder why that's set up that way. So, for example, let's walk through one of the shopping experiences you might have had last weekend. Bought a new T-shirt, gone to a retailer in Oxford Street, and now just imagine that the farmer in India and the producer in Spain would only receive their share of the payment for your T-shirt after you purchased that T-shirt in Oxford Street last weekend. Most likely that farming industry in India, the producers in Spain would revolt quite a lot, and most likely the retailers in Oxford Street wouldn't have to deal with all of the regulations and the pressure of handling the rest of the supply chain's money. So that's the reason why we do know that in any other payment flows, the structure looks a little bit different. And the structure looks that one payment in a normal supply chain goes to one entity in its entirety. So that means when you purchase your T-shirt, all of that money goes to the retailer, and the retailer can keep that money. And likewise, the retailer between the producer. Therefore, they assume a certain business risk, but that means as well that the payments are already made once the first goods start to move between the various different distribution partners, and not right at the end of the payment. Now, that means that insurance is quite unique in the way payments are being transmitted, and that is in some regards similar to some other financial industries, but very much pronounced in insurance because of the very important role of insurance intermediaries. Now let's look into that topic around the insurance intermediaries in a little bit more detail. As we all know, intermediaries are the backbone of the insurance intermediary, and that traces back all the way to the 18th century. I know there are a couple of people on the call who know like insurance history far better than I do, but as a quick overview, a couple of historians trace the real specialization of brokers back to the starts of the insurance being placed here in London, when the 18th century brokers had to develop key connections to the seafarers who wanted to purchase insurance for their ships and their goods, and B, had to be very specialized because insurance companies wanted to grow, wanted to diversify, couldn't be too picky. So the brokers were the ones who built up the specialization, and all of that ultimately like developed into what we see today. And the picture is very, very clear. Just to underpin that with a few numbers, at the moment in the UK, there are around 2,000 intermediaries, roughly 1,600 brokers and 400 MGAs, and there are 420 insurers. So that means we have almost 5 times as many intermediaries actually in the UK insurance market than we have insurers. And at the same time, we do know that insurers on average are significantly larger than the average intermediary. However, if we look at the number of employees on the right-hand pie chart, we see that still 2/3 of all employees within the insurance industry work at intermediaries, meaning that unique payment flow, which we saw on the previous slide, and the role of the insurance intermediaries, how deeply embedded they are, both from the number of organizations and the number of people employed, is here to stay and is the reason why we're seeing those flows. Now, what that all accumulates to is a really nice information which was shared with me by MasterCard during a conference in Amsterdam. And the statistic they shared with me is that the worldwide gross domestic product generates 4 times its value in payments every year. So that's the t-shirt flow, which we've seen that a t-shirt worth £50, for example, triggers overall over its life cycle at £200 in payments. Now, in the insurance industry, one insurance premium generates 7 times its value every year in payments. That's nearly twice as much as the average gross domestic product, and gives you a quite good feeling for how complex overall the payments in the insurance industry can be. Now, let's dive into that complexity. What are the challenges? What are the key obstacles which are being presented by premium payments? Now, going back to the flow, that's the entire thing which underpins that situation in the insurance industry. And let's dive a little bit deeper into what happens in a more granular level between the various different entities in that distribution chain. The original insured sends a premium payment. As we said, that could be for an amendment for a policy, or it could flow the other way for cancellations. That premium payments is then transferred to the broker, of which the broker can keep their share, but needs to pass on all of that share, which is here depicted in the dotted line. Now, the MGA and insurer share then needs to travel to the MGA, who can clear their share. The insurer gets their share then last. Now, fairly simple, you might say, still a lot of work, but what if you overlay that with any admin fees you as the MGA might want to charge, which needs to be transmitted by the broker? What if, or not what if we consider as well like the insurance premium tax, which needs to travel all the way to the insurance company at the end? What if you want to use like a payment service provider to place your policies? Then you have a payment fees. What if there's an underpayment or an overpayment within the chain, which then distorts the payments which are ultimately being made? Or what if cancellations are being offset with the other direction of payments, so that you have like a net setting effect? Now, the picture that opens up here, I think, is fairly clear. It's getting quite complex in the insurance industry when we talk about processing premium payments. Now, from your point of view as an MGA exemplary, a high-level reconciliation journey might look something like that. You might receive bulk payments from a broker and a remittance file with that. You then have to make sure that whatever arrives in your bank account, which tends to be the client money accounts, matches up with that remittance file transmitted. Now, once that is being established, then you need to make sure that all of the entries you hold in your policy admin system are in line with that payment from the broker, and as well are in line with the contracts you have made or have made with the original insured. Once you've figured out your internal position, then there might be like a bordereau or an insurer reconciliation process where you need to get alignment with your most important business partners, the insurers, to make sure everything is fine. And only once that's being completed, then the money can move. Now, that picture looks pretty much identical for the brokers on the left-hand side and for the insurers on the right-hand side. So what we see in that payment journey is a lot of duplication of effort and a very detailed, a very laborsome process. The result of that is being depicted in the next slide. Now, first of all, the good message. All of you on the call, you're not alone. There are $1.75 trillion every single year flowing through such a complex split premium journeys every year, which incur 32 billion in operational costs. Now, those $32 billion are driven by one key factor, which is the excessive manual work to get the reconciliations done. So teams are deploying or entities are deploying teams of people between 2 and up to 65, sometimes even over 100 people, just focused on the reconciliation in the insurance industry, which obviously drives very, very high expenses. At the same time, with an average of 100 days to receive, reconcile, and clear commission, we have huge delays in making sure that you invest the money which belongs to you in the most accurate fashion. And we'll dive deep into that in one of the following slides. And then lastly, with the manual processes, with the complexity around the different data sources and complex reconciliations, there are like many risks. We are dealing with A, payments, B, in a regulated environment, which makes it very, very necessary to deal with all of those processes in the most compliant and most professional fashion. And that's exactly that part where we now want to dive deep in the next 2 slides and kind of open up the picture of what maybe is often missed with premium payments. There is a huge hidden risks which are being carried by entities when transferring those client money payments between different accounts. Now, those risks, in essence, fall onto 3 key business partners or 3 key institutions which you as an insurance intermediary or insurer have to deal with. Now, first of all, the FCA, the regulator we're all bound by, their key goal is to protect the original insured. Now, the premium payments are in essence the most important factor to making the claims payment ultimately. So the FCA has a very strict view on making sure the premium payments flow nicely, get all the way to where they need to be at the insurance company so that claims payments can be made. Now, if that's not the case, we saw in the industry over the last couple of years quite a lot of fines, which can go up to multi-million dollars. We heard about mergers and acquisitions being blocked by the FCA because client money accounts or audits were not satisfactorily done. And even the loss of a trading license can be discussed if not managing the finances well. Now, onto the insurance partners, the most important partner in your journey as an MGA. Cash flow forecasting is something which is currently like barely done in the insurance industry, which is quite surprising, given that insurance companies need to manage that delay of receiving premium payments and paying claims afterwards. Now, the key thing here is to make sure that you share insights to your partners in an as detailed and as clear way as possible, so that there's no friction being introduced, which creates a risk for your business if that's the case. And then most likely, most importantly, the original insured, that's the reason why we're all sitting here. That's ultimately the ultimate client in our industry. We need to make sure that those clients are serviced to the best of our abilities, and not managing their premium payments well means that they might be exposed to not being covered in the case of a claim if the payment didn't arrive at the insurance company in time in an addressable fashion. So these are all of the various different entities which are involved. And if you mismanage like someone's money, that's the quickest way to lose trust. So that's the key phrase for this slide. And with that, I want to hand back to Carissa to dive deeper into the specific risk criteria which we're seeing exposed to those three different partners. Now, Carissa, over to you.
Perfect. Thank you, Julian. So yes, just to dive into a greater level of granularity around the risks, as there are a number that are associated specifically with premium processing. We've identified about 6, and we've consolidated these into what we'd like to present to you. The first of these being credit risk, credit and liquidity. So adequate liquidity is paramount for the success of any business, regardless of size or industry. But in insurance, the added risk is that poor cash flow may impact the ability of an MGA, for example, to make insurer payments, which could lead to breaches of contractual obligations. On the other hand, payment may have been received by the MGA, but the MGA may still suffer unnecessary financial strain when valuable cash resources remain trapped in unallocated funds. If you recall from the previous slide, Julian was referring to the 100 days to even get commissions paid. So all of those factors contribute to the cash flow, which what we found is not that proactively managed. So that in itself being the risk. Number 2, around operational risks. So process errors can really impact every part of the organization. And with premium payment and reconciliation processes, we found that they are often disjointed with inconsistent data and very isolated systems between MGAs and brokers, and similarly between MGAs and insurers. And as a result, dedicated resources are required at each entity in the value chain, as Julian alluded to, with the significantly larger number of resources in the insurance intermediaries compared to the insurer. And these resources sometimes are up to 60 people who are actually trying to untangle these unallocated funds and getting to the point where cash flow can be managed and where payments can be made either way in the value chain. The process of this reconciliation has also remained predominantly manual, with many phone calls, emails, and hours of Excel-based spreadsheet updates. This is predominantly what seems to be the solution. But now, besides the time and effort involved, the real risk is the errors, such as rekeying mistakes, or actually inaccuracies in complex premium calculations, culminating in discrepancies, underpayments, overpayments, and late payments. And this has become a perpetual cycle. The third risk is that around fraud. I think we've all seen the media of late with reports of phishing attacks and hacking attacks. I think it's got us all sitting on the edge of our seats and hoping that we're not the next target. So there are external fraud risks, such as the sophisticated cyber attacks, and there's also payment fraud. And they pose significant threats where criminals attempt to divert premium payments through these mechanisms. However, the high degree of human intervention in the premium processing also increases the risk of fraudulent activities, including embezzlement of funds. And this risk is heightened when internal controls are weak, and specifically when management oversight is impacted and limited by delayed reporting and insufficient insight where the funds are actually coming from and how they are allocated. The fourth one is around compliance. Now, I think we must obviously operate in one of the most regulated industries. And I've just picked two scenarios in terms of the compliance risks, because they are numerous. But the most glaring one is that around client money regulation risks, which arise when payments received cannot be reconciled and are subsequently paid out or reported outside of the agreed timeframes. These funds can represent substantial sums and may remain trapped for extended periods. And in some instances, we've heard of those funds sitting in unallocated resources for numerous years, not only months or weeks, leading to the risk of financial penalties and damaged relationships with both insurers or brokers, depending on which way the funds were due. Similarly, inadequate data accuracy could result in missed anti-money laundering red flags, increasing the risk of non-compliance and potential legal consequences. So these are the two predominant compliance risks. Related to this, though, is risk number 5, which is around market risk, and that also includes counterparty risks. As we know, there are forever changes in insurance rates. We're experiencing a lot of economic downturns, and of course, the ever fluctuating exchange rate, which all impact on both the volume and the value of premiums received, again highlighting the need for prudent cash flow management. On the other hand of that equation, from a counterparty risk perspective, these market conditions could also cause delays in payments from insurers and third-party payment providers, and in turn disrupting MGA's operations and cash flow. Finally, the third risk, we've called it contractual risk, but it's very closely associated with reputational risks. The common thread in all these risks is that ultimately the mismanagement of premium payments can erode trust, lead to loss of lucrative TOBAs, result in legal disputes, and unfortunately at times result in financial penalties. So having painted that very doom and gloom overview of the risks, I'm going to hand back to Julian, because we have found a few concepts that we would like to suggest in mitigating some of these risks.
Perfect. Thank you, Carissa. Before we jump into the opportunities and dive a little bit into the good solutions, Jim, if you could please launch the first poll. Everyone, we want to quite get a quick understanding of the room. In your opinion, what is the biggest challenge in managing premium payments at the moment? Is it A, the amount of manual work which has to be done, B, the delays and the lack of transparency in the process, or is it the hidden risks behind the various different payments? Perfect. The first answers are in. We're leaving that open for like another few seconds, but so far it seems that we have a winner, or like the biggest challenge at the moment seems to be the amount of manual work being done, with 67% of all people saying that's the number one. Delays and lack of transparency range on 22%, and the hidden and obvious risks on 11%. That's much appreciated. Thank you, and I think it reflects as well what we've seen in our conversation so far. Okay, back to the presentation. Yeah. Okay, back to our familiar payment flow. That's what makes our industry unique. That's how the payments flow. That's where the challenges arises from, but that's as well where the opportunities lie. So the key phrase here for the next two slides is time is money. When you have money for longer, when you get money quicker, you can make more money with that money you hold. I think that's quite straightforward. If we go through the distribution chain here, we have, from the broker's perspective, 3 key tasks each intermediary has to complete at any given time when we talk about premium processing. The broker needs to get paid, needs to reconcile, and need to pay out those funds. So they need to chase the insured and try to get the money as quickly as possible, or whatever is convenient for the insured, run their operations as fast and as frequently as possible, and then schedule the payouts into their own commission accounts onwards to the MGAs as fast as possible. And all of that process end to end takes a certain amount of time. Likewise, the MGA repeats that process. They need to chase the broker to get paid as fast as possible. They need to reconcile their internal operations, and then they need to pay out into their own commission account and onto the insurer. And the insurer has two of those three different aspects in that example where they need to chase the money to reconcile. Now, especially around the intermediary payment chain with the broker and the MGA, we saw that an average time it takes for an MGA at the moment to be paid, reconcile and pay out those funds is around 100 days. Now, for our example, we took something which is in line with what many people expect, a 90-day settlement due term. And that 90-day settlement due term, we split out between 45 days for you as an MGA to receive your premium funds, and 45 days then where you hold those funds, do the reconciliation until you clear the accounts and pay out your commission and the insurer payout. Now, with those two factors, you have in essence 40 days in which you hold not only your share, but you do hold as well the insurer's share. You do hold potential insurer fees, you do hold taxes, and all of the other components which we've seen in the build-up of the payment cycle. Now, that's a potential investment period for that money when you hold those funds. At the same time, it takes currently 90 days until you have cleared your commission from when you sell your policies. Now, that's 90 days where you can't deploy that commission into your business to grow faster, to hire more people, to come up with better distribution or better underwriting methods. So let's go through a quick calculation for a model MGA. Just assume you're an MGA, fast growing, currently at £5 million in gross written premium every single year. You clear a 20% commission of that. And we are in a market environment where there is 5% of risk-free interest accounts for you available at the push of a button. And you do grow modestly, but successfully with 10% every single year. Now, with those statistics, the 40 days where you have the potential investment period, you could make £31,000 every single year by just managing that money more effectively. At the same time, if you brought down the commission, if you brought down the time you wait for your commission, you can make an extra risk-free £25,000 every single year, which you would generate by reinvesting that money into your business and into your growth. So overall, for that model MGA, we see a cost of over £56,000 every year, or like an additional revenue you can make for £56,000 every year, which is over 5% on top of your current revenue. So there's a huge opportunity really when we talk about premium payments, which are currently driven by the delays and are as well driven by the fact that you hold more money than in essence you can clear at the end. And if you manage that well, there can be a very easy way for you to generate 5% extra income every single year, which is quite a phenomenal number. And at the same time, it's not only the financial return you can generate, it's as well more the softer benefits you can get out of those premium payments. Now, with the current structure as we see it, there is so much information which is currently shared around the premium payments, which is valuable for your underwriting and for your business analysis. So let's start at the top left. We see here a little card which depicts the various different payment channels. Now, in today's world, you want to give the original insured an as easy checkout experience as they see with their online shopping. So that means some customers, depending on the lines of business as well, might want to pay with bank transfers as traditionally done. Some want to use financing providers. Some want to use open banking solutions. Others want to pay by card or anything in between. It's our job as an industry to meet the original insured where their demands are and make their checkout experience as easy as possible. But at the same time, that means for you as an insurance intermediary that you can generate various different revenues by offering certain different payment channels or by understanding what the delays are and the error rates are per payment channel. And you want to steer that in line with your business and in line with your customer demands. Now, once you accepted a given risk and you start either working with companies, or you use introducers or brokers to distribute your policies, you always have a third-party liquidity risk, as Carissa described in one of the slides earlier on. Now, to manage that is very, very crucial. The insurance industry is built on trust, and we are a very, very collaborative industry. However, if like an entity is in distress, that is valuable for you to know and to need to make sure that you manage that exposure properly, so that not, if there's like a large market downturn coming, that you might be exposed because a large amount of your funds are being held by a third party, which is not financially secure. So that credit bureau data can be crucial for your analysis. Liquidity forecast at the bottom left is something which is, in my opinion, almost completely overlooked in the insurance industry. We're dealing with often huge sums of money, where other entities and other supply chains would be very, very keen to have an accurate forecasting of when money comes in, to plan their expenses and their income in the most effective way. In insurance, is often not too much transparency in that regard, so that it needs to be more a broad brush approach, and you can really only use the money which you make today in 90 days, or maybe sometimes 120 days, maybe sometimes 15 days, but you don't have a good handle on it, and that costs you valuable insight and valuable gains which you could make with that. And that's kind of the key aspect of this slide and of this section. There is as well, it's not only a doom and gloom and fixing those challenges, but at the same time, there's another side to premium payments, where you can turn premium payments in a profitable into a profit center, and you can derive really valuable insights for your chief underwriting officers, for your chief strategy officers, to grow the business and make it more profitable. Now, the question obviously with all of that comes, what are the best practices? How can you do that? And we have structured that section in two different parts. First, we want to walk you theoretically through that process, and then show you how we set it up at Diest, to give you a couple of ideas. Now, the key message for this slide is that premium payments with the unique journey means that each entity combines at any given time when you receive premium payments an accounts receivable, a bank reconciliation, and an accounts payable journey into one process. And that must be as well the motivation with which you tackle that process. Now, let's walk through the four steps in detail. Number one, there are multiple different data sources which a financial controller in the insurance industry as an intermediary has to reconcile. There are different bank accounts, different currencies, there are different policy admin systems you might operate on. There are remittances from your payment gateways or from broking partners, there are insurer statements. Now, first of all, you need to bring all of those different files into one common database, ideally with the same frequency, updated so that you have one view of the truth. Now, once you have that, then we're dealing, as I described earlier, with a multi-stage process, which often involves as well multiple entities. So key here in the next step is to define your team, build your ideal team member to focus on each of those different processes, but make sure as well they know their clear role within that multi-stage process. I mentioned process. It's not good enough to know like what are the steps each team member has to take and where their responsibilities and where's their permission limited. You do need as well from the get-go, need to make sure that you have the right answers when underpayments come around, when there's a question around a write-off or a cancellation happens, when there's like net setting or like different payout schedules. Make sure you have all of those edge cases well addressed ahead before the month end, so that you can really navigate that problem easily once it arrives. And only once 1, 2, and 3 have been completed, then focus on automation. That's when like the real benefits come in, when you can start to streamline all of your bank reconciliation, the insurer statement reconciliation, and can make sure that you put a lot of rules, algorithms, and some clever things behind it to make sure you can run the process end to end. Now, with that theory, the key thing for you to address then as well is some of the risks which we alluded to earlier. So I would hand back to Carissa right now to walk us through a little bit the risk mitigation which such a comprehensive handling of premium payments would bring.
Great. Thank you, Julian. So with 6 risk categories that we chatted about earlier, we also have 6 suggested mitigation strategies. The first one would be around cash flow. Now, you've heard us reference that quite a lot. Managing cash flow effectively would be the #1 strategy. But the real key, the real distinguishing factor in managing that cash flow would be to have real-time reconciliations, enabling proactive recovery from any potential obstacles. Secondly, given that it is so manual and given that we need processes, we really need to ensure that we implement very strong internal controls, and specifically from a compliance perspective is to make sure that our segregation of duty is clear, even for a one-man team. At the basis, obviously, that is between reconciliation, generation of payment advice, and actually paying out those funds. Thirdly, is to use secure automated systems for premium processing and payment tracking. This not only speeds up the time to near real-time reconciliations, but obviously addresses a lot of the manual risks that we discussed earlier. #4, we need to maintain compliance and regulatory requirements and ensure that we have clear, transparent agreements with both brokers, insurers, and third-party providers. #5, you'll all know that we need to conduct regular audits and reconciliation of client funds, but what's really important as part of the process is to make sure that there are clear evidence items that create a reliable audit trail. And #6 boils down to communication and collaboration. So we need to ensure that communication and collaboration with clients, insurers, and third-party providers happens, but ideally with a single source of truth or a common platform in which common data and overlapping processes can be efficiently optimized and improve those communication channels to be quick, effective, and reliable.
Perfect. Thank you very much, Carissa. Now, with what we presented here now as the best practices from the theory and the risk mitigation side, we want to jump into showing you, and we're quite excited about that, how we set up the Diest system to cater for all of those various different points in the best possible fashion. Now, what the Diest system in essence does is it links all of your premium systems and data onto a single system from where we then can perform our automation and can run that multi-stage process and multi-entity process on one common tool. So let's go through it. On the left-hand side, that's where each reconciliation process in the insurance industry starts, is with the various different data sources, the policy admin systems, the bank accounts, which include your client money accounts, your operational accounts in various different currencies, remittances, which can be driven by your broker payments or by payment gateways, and insurer statements. Now, we take all of that data and ingest that into the Diest platform. Now, you can think of us like an automation middle layer, same as what the underwriting workbench is for the underwriters, is Diest for the finance team and insurance. We combine all of those different data sources, ingest those via APIs, via open banking. We use AI to ingest a whole bunch of different PDF and Excel statements and bring that to you in one tool in a standardized fashion. Now, with that tool, for the first time now, Diest is built from scratch only for premium payments. So that means you don't have disjointed processes anymore between like your accounts receivable and credit control being in one system, and then you have to download a report and your bank reconciliation happens in another system, or you might have to type manually your bank payments into your systems. And then like your insurance payable ones might live in a different system or different spreadsheet. And all of the workflow might be underpinned by emails, again, comments in spreadsheets, drawings on certain paper files or so forth. Now, that won't be the case anymore, because with Diest, you can run everything from your broker statements to your credit control on the same platform. You can do your bank reconciliation over various different accounts, different currencies, different geographies on the same platform. And all of the reconciliation, including the statement reconciliation you've done, feed directly into the payment services, which makes it easy for you to schedule your commission payment and forward the money on to the insurance partner. All underpinned, as Carissa alluded to, on one platform where you, your sales team, your business partners can all come together, collaborate, comment on what is actually the entry, the problem, and go from there. Now, to bring that a little bit more to life, we brought a small animation which highlights the process of ingesting various different data files, bringing them together, and performing an end-to-end journey. So I'm going to let that play quickly. Where we see here exemplary policy systems, bank accounts, insurer statements, and even like contract reconciliation, all being pulled together into one system. Once that's established, that's when we can start to perform various different internal finance functions, like the bank reconciliation, credit control, or external services around sending statements, making sure your data aligns with your insurance partners and your broking partners. Now, on that short description of what Diest does, Tim, I would like to ask you to trigger the second poll, please. Perfect. The question of the second poll is, what do you think, in your opinion, is the most useful feature for managing premium payments? Is it A, centralizing all data sources in one database? Is it B, establishing clear roles and permission for teams? C, defining all necessary processes upfront? Or is it D, automating as much as possible to have a standardized fashion? Here we have the first answers coming in. Thank you very much. I'm excited to see who will be the winner. We let it open for a few more seconds. Okay, we have a head-to-head race between centralizing all data sources and the automation. If we get one more vote, then we can close it and we will have a winner. Anyone? 1 or 4? Oh, okay, we got it. Thank you very much. So we got a winner. Automating the majority of bank transaction is the most important feature of the premium processes, followed by centralizing everything into one data source. And on third place is clearly defining all necessary processes upfront. It's very interesting. Thank you for sharing this. And great, yeah, perfect. Moving back to the presentation. Carissa, over to you.
Perfect. I'm very aware that we'd like to open the floor to some questions. So really, just to recap, have we achieved our learning objectives? We were hoping that by the end of the session, it would be very clear and it would be possible to explain the unique challenges of premium payments compared to other industries. I think we've hopefully covered that. Number 2, we wanted to outline the key opportunities that premium payments offer. And number 3, to summarize potential solutions and mitigation strategies for innovating in the space of premium payments. And I hope we've achieved that too. And that leaves us to any questions, opening the floor to that. I don't know if there's any last concluding comments that you'd like to make, Julian.
No, I'm very interested to hear if the panel has any questions. And yeah.
Yeah, so just to follow that up, do feel free to type in any questions in the group chat, or indeed come off mute if you wish and ask them live, entirely up to you. We have no questions so far, which must mean that you've covered everything very well, I think. So I don't know, Gillian, if you've got any last points to make, anything to shine a light on and highlight why Diest?
Yes, so Diest is really born out of the experience in the insurance industry. For the first time, we believe that there is like a need for the unique payment journeys which we have in our industry to have a tool which is built from scratch just for that unique journey. And that's what we've done with Diest over the last 2 years. And we've been very blessed to have received a lot of support from the market, from various different institutions and insurers. And we would be very interested to speaking with you about how you run your processes, what's working really well for you. And we'd be happy to share a couple of thoughts back. So if there's any interest here of anyone in the room or watching the video at a later stage, please feel free to contact us at any time, either under hello@diest.co.uk, look at our website, diest.co.uk, follow us on LinkedIn, where we always put up or try to put up a lot of insightful knowledge and events around the industry. And we're really looking forward to connecting with you and helping to streamline premium processing for the insurance industry. So thank you very much, Tim and the MGA for having us.
Thanks very much, Julian and Carissa. Much appreciated. I'm sure everyone will agree that's been a really valuable session. And as Julian mentioned, you can reach Diest at the contact details which are shown, or do feel free to contact me alternatively at tim.richards@mgaa.co.uk with any questions or introductions, and I'll be happy to pass these on. So thanks all of you for joining us. Thanks once again to Julian and Carissa, and I do hope you have a productive afternoon, and we'll see you all soon.
Likewise. Thank you very much.
Thanks again.
Bye.
Bye-bye.
Bye.